For quite some time, I have been talking about how insurance, especially homeowners insurance, is usually a giant ripoff. And this most recent debacle that we're seeing happening play out in Florida with so many people seeing their insurance claims denied is absolute proof of that. Now, I'm going to talk to an insurance agent pretty soon, and I'm going to get some more info about some things that people can do to kind of like have the best balance of the right amount of insurance but not be paying too much and things like that. So I'll make a future video with some tips, but for right now, I want to give people an idea of how much money people have lost due to insurance companies not paying out claims. So obviously we just had Hurricane Milton and Helene hit Florida within the span of a couple of weeks of each other, and this was less than a month ago. A lot of people who are making insurance claims are continuing to see those claims get denied. And actually, the amount of claims that have been denied for homeowners insurance in general has been going up over the past couple of years. So far, just since these two recent hurricanes, there's been over 37,000 claims denied in the state of Florida. According to the data compiled by the Florida Office of Insurance Regulation, as of October 23rd, 84.2% of claims relating to Milton and 68.2% of Helene claims are not yet complete. And all of these claims are either going to result in a payment or the claim getting denied. For both incidents, there's been about 359,000 claims made and about 38,000 have been denied. So about 10.5% have been denied so far. So why are all of these claims being denied, you might ask? Well, according to the insurance companies, the reasons are things like insufficient information, missed premium payments, fraudulent claims, or missed filing deadlines. And also, a closed claim without payment is a claim deemed not currently payable by the insurance company. So they say that a lot of these claims that go without payment are likely because they're primarily flood claims that are not covered by a standard property insurance. Flood is also not covered if you have a condo. It's like, for example, if you don't have separate flood insurance policy, then your claim will also be denied even if you live in a condo that got flooded from this storm. And get this, guys, out of the 727,000 Hurricane Ian claims that have closed, 198,000 were closed without payment. 25% no payment for you. And keep in mind, people in Florida pay basically the highest insurance premiums in the entire country now. For the average home valued at $300K in Florida, people are paying upwards of $5,500 a year. Now that's just an average. It doesn't mean everybody's paying that. I know there's numerous examples of people that are living in more inland communities, higher elevations, that are still paying, $2,000 a year. So it's not like I don't know that. You don't have to write the comment. And insurance companies are going to find any way to point to the fact that the damage was caused by a flood and not wind or rain or any other event that's covered under your policy, because the less they have to pay, the better for them. Okay, it's not in their interest to pay you, because the business model is collect as many premiums as possible and have as few payout claims as possible. But the situation actually gets worse from there, guys, because according to a company called Weiss Ratings, half of the 40 insurance companies that they analyzed recently failed to pay on at least 30% of all of the claims that were made. And specific ones in Florida like Kin Insurance, American Integrity Insurance, and Pure Specialty Exchange did not make payments on over 40% of the claims that were closed in 2023. So this is why I go back to saying that getting homeowners insurance is a complete scam and a complete ripoff, because you have to have it. If you have a mortgage, there's no getting out of it. Okay, you cannot escape this. You need to get homeowners insurance, whether you want to or not. You do it, right? Then something happens, you go to file a claim, it either gets denied or they pay you, but even the people who do get paid oftentimes don't get paid out as much as they thought that they would. And also there's deductibles and other expenses that you need to cover on your own as well. And let's not forget the amount of time it takes to process a claim, especially when a big weather event like this happens, can leave you in the lurch for months. Some people have even been left in the lurch for years over stuff like this. This is a major problem in Florida in particular, but other people across the country have written me stories as well, saying how they've had such a hard time with an insurance company to the point where you need to take them to court and you need to sue, and then at the last minute they end up settling, bogus things like that happening, which ends up just wasting a ton of your time, a ton of effort, lots of frustration. It used to be, 20, 30 years ago, that having insurance felt like a safety net. It felt like, oh, if something does happen, at least I know I can count on my insurance company. They're going to be there, they're going to pay the claim, and they're not going to drop me afterwards. Because even if you are one of the lucky ones that does get a payout and the proper amount on top of that, and it ends up making the difference of losing your home or not, now you're in a situation where your premiums are likely to go way up, and if that doesn't happen, then you may end up getting dropped and have to find a new insurance company. So nowadays, it's this endless cycle of worry when it comes to homeowners insurance. You constantly have to try to look for new companies, look for better deals, always be on the lookout essentially for somebody else. This would be like being married and still have to go out on dates all the time just in case your spouse doesn't want to be with you anymore. How exhausting would that be? That's what people are going through with homeowners insurance right now. Now, real estate in general is completely in the toilet right now, guys. In fact, the existing home sales in September just fell to the lowest level that we've seen since September of 2010. And that's just the month of September, okay? So you can look back and say, well, home sales are the worst they've been in 14 years, but it's actually worse than that, because when you look at the annual amount of home sales, the sales are actually worse than they've been since 1995. This is how few homes are being sold today. So in September, home sales went down 1% from the reading in August at an annual adjusted rate of 3.84 million. This is according to National Association of Realtors. Year over year, existing home sales are now down 3.5% as of the September reading. And even though the median home price rose 3% from last September, guys. So once again, median home price is going up because there's so few sales taking place that the ones that are taking place are on the upper end of things. So that makes the median home price go up because naturally the people that can afford to buy in this environment can afford to buy a more expensive house. And since we're seeing more sales on the high end than on the lower end, naturally it pushes up the median home price. But it doesn't mean home prices across the board are going up, even though the figures can give that impression. And what this data reveals is that the home sales are stuck, Home sales are stuck at or below 4 million homes per year, and I'm going to show you in a minute just how low that actually is. So when we take a look at this graph here, this shows you annual US existing home sales going all the way back to 1981, okay? And where you can see we're today, all the way on the right-hand side of the graph, is the lowest we've been since 1995. But it's almost just as low as it was back in the mid-1980s as well. We're not very far away from that. And you can see with perspective just how many homes sold during the last housing crash. Before that boom, the amount of homes sold was tremendous. Even made today's home sales that we saw during this last housing boom look like nothing over the past 4 or 5 years. So this is extremely low. The average before this was running around 5 million home sales a year. We're at 3.8 right now. And to give you guys some perspective on just how bad this is, think about this. Today, there's approximately 346 million people living in the United States. And that doesn't count all of the illegal people that just came in here recently. But back in 1995, the US population was 261 million. So that is a 75% increase in population since 1995, but we're seeing these sales levels down to 1995 levels. If that doesn't tell you how bad and how slow this housing market is, if that doesn't paint the picture, I don't know what will, guys, because so many people are just living in the bubble right now of just looking at the median home price. It's going up, fantastic. Everything must be great. Stock market still at all-time highs. Everything must be great. That's all that people look at. Oh, the restaurant down the street is always busy. The mall near my house is always busy. So everything must be fine. But that is not true. When you really start digging into the details and looking at what's going on right now in this economy and within the housing market, it paints a much different picture. The problem problem is most people don't dig that 3 or 4 layers deep like I like to do here on the channel. They just look at those surface level figures and the news headlines, and they take a look around at their own life and they go, oh, I can still afford my house and I'm still okay, or I'm in retirement, everything's fine. So these people must be crazy. But you want crazy, I'll tell you something that's crazy, okay? The Fed made an interest rate cut of 50 basis points about a month ago in September. And back then, interest rates were sitting at about 6%, which was a big drop from about 7.5% where they were just a year ago. But as soon as that rate cut happened, the mortgage rates have been steadily rising ever since, with a couple of really big jumps in between. In fact, take a look at this, guys. We've had 2 days where the interest rates jumped basically 25 or 30 basis points in just one day. It went from 6% to now today, as I'm recording this video, to now 6.91%. Why is this happening? Because the Treasury market is forcing it to happen. 30-year mortgage rates track the 10-year Treasury. And every time the 10-year Treasury sees an increase, so do 30-year mortgage rates. Mortgage brokers are complaining about this because this has basically sucked the air right back out of the market. There was a small little uptick in home sales during this short reprieve of mortgage rates, but that was very short lasted, guys. That's over now. Now that the mortgage rates are back up to basically 7%, no one's going to be buying. Even though prices are coming down, it is still far too expensive for the average person to pay this price along with that mortgage rate. And the other layers that people fail to peel back when they're looking at these sort of things is, why are the Treasury rates going up right now? Because the Fed thought that by dropping the federal funds rate, that interest rates on the treasuries would go down. But in fact, they're going up. And this is interest that the federal government has to pay. And if the reason that they dropped these interest rates was to try and save the federal government money on the amount of debt that we owe, the plan is failing miserably. It's not working. And you got to think about this. Lenders sell mortgages to investors, okay? And those investors demand a bigger return, particularly when rates are volatile with the Treasury market, because mortgages are a riskier investment than government bonds. So if you're an investor that buys mortgages, you could just say, well, I can just buy the 10-year Treasury at 4.5%. So if I'm going to buy a mortgage, I need a big enough spread and enough additional return to make it worth that investment, because maybe the mortgage holder will default. In fact, that's something else that's happening too that we'll get to in a minute. Unsurprisingly, you also have mortgage applications falling 4 weeks in a row. And so right now, we're sitting at about 4.5 months of supply on the US housing market. So while all this is going on, the supply of homes for sale is steadily increasing. We're not talking huge swings or, giant dumps of inventory on the market, except for in Florida. But what we're seeing is just a gradual increase in the month supply of homes for sale, because as fewer and fewer people continue to buy houses, more and more supply continues to build up. Here's something else interesting that we're seeing happen in the housing market right now, is that the typical down payment is starting to go down, which can mean a few different things. The average down payment fell from $30,300 this quarter down from the $32,700 last quarter. And they also say that the September interest rate cut is expected to lower mortgage rates and housing prices, and many people note that it's too early to determine if lower down payments foreshadow a larger trend in sales and housing market behavior. So obviously, the market is acting completely the opposite of what everybody thought was going to happen after the Fed rate cut. People are putting lower down payments for a couple of different reasons, I would imagine. The first one is there are areas across the country, many actually right now, where prices are falling quite substantially. People are getting, $20,000, $30,000 off of the asking price of homes. And if you can pay less for a house, well, guess what? You don't need to put as much of a down payment. That's one reason this is happening. Another reason it could be happening is because people don't have the money to put larger down payments. But I would assume most people who are buying a house, they do have some kind of cash, unless you're going in with like a VA loan or an FHA loan and you literally are going in with a very small down payment. Those people don't really have as much money to put down. But right now, the experts are predicting that home buyers will see a notable difference in housing prices and mortgage rates in 2025 after several more anticipated interest rate cuts come from the Federal Reserve. Well, not if we continue seeing this current situation play out. We're not going to see that happen, because what will happen if the Fed keeps cutting rates and the Treasury markets don't believe that inflation is tamed, these Treasury yields are going to continue to rise as the Fed cuts rates. So think about it. Their next meeting in November, they come out and cut rates again, another 25 basis points, right? And then let's say the 10-year Treasury goes from 4.5% to 4.8%. or 4.9%, something like that, right? What do you think is going to happen to 30-year mortgages next? It's going to be pushed back over 7% if it doesn't happen even before that, because it looks like it's already almost there. So the more that the Fed cuts rates right now, thinking that inflation is tamed and all these bond investors don't believe it, the higher that these Treasury notes are going to go. This situation alone could actually end up forcing the Federal Reserve to start reversing course and raising interest rates once again. I think the likelihood of that is pretty low. They may just choose to print more money, which seems to be the course of action they usually take, but you never know. And you know, here's something else to note, guys. If you're somebody that has been stacking cash away during this time of higher interest rates, you're a smart person, right? Collecting extra money and getting paid a higher amount of interest on that money than we could have gotten within the last couple of decades before. But now, we're seeing the mortgage rates shoot up substantially, pretty much an entire percentage point just in the last month, which is kind of unprecedented when you go and look back at that graph. When was the last time you saw mortgage rates jump by that much in such a short period of time? This goes all the way back to last year. You don't really see anything like that. But this also affects the other credit markets. And so people are also paying higher interest rates on their credit card loans right now. People are also getting higher interest rates for auto loans once again. But if you notice, the one key important thing for interest rates that hasn't been going back up is savings accounts interest rates. The banks are still screwing everybody over right now, continuing to lower their savings rates for people who are saving money. Well, how unfair is that, guys? Everybody else who's collecting interest, if you're a mortgage lender right now, you're collecting higher interest. If you're a credit card lender, you're collecting higher interest. If you give out auto loans, you're collecting higher interest. But the average everyday person, the saver, the responsible person that has extra money and isn't completely drowning and living off of debt, is getting punished right now as the savings rates continue to go down. And the excuse for all of this is because the economy is stronger than we initially thought. Maybe the Fed won't be cutting rates as much as they said they would. But what all of this really means is it's a giant warning that inflation is coming back with a vengeance. We already saw it in the last inflation reading, and we might see it again in the next couple of inflation readings. Because the core inflation, the PCE, that the Fed likes to use the most as their gauge on inflation, has actually been going up. But they don't use that number now in the headlines anymore. They just talk about the CPI and how that's going down. And this whole CPI number is completely designed to make it look like inflation is going down. It is completely doctored to the point where the numbers are supposed to make whoever's in charge look good, guys. And while all of this is going on, we're seeing mortgage delinquency rates on the rise again. Actually, for 4 straight months in a row, mortgage delinquencies have been on the rise. And they say this is the longest stretch that we've seen of mortgage rates delinquencies going up since 2018, which of course was pre-pandemic. According to the recent report from ICE Mortgage, the total delinquency rate, which is defined as 30 days or more late on a payment but not yet in foreclosure, is sitting at 3.48% in September, and that was an increase of 4.3% compared to August reading at 3.34%. And this is also up 5.74% since September 2023's reading. And also in similar news from the Mortgage Bankers Association, they say that a lot of people that were in forbearance all of this time that are coming back out of it are mostly the ones who are missing the payments, which is not a surprise at all. And according to the ICE vice president, he said that elevated interest rates over the past couple of years have resulted in higher debt-to-income ratios. Modest rises in unemployment, along with the recent natural disasters, have made it more difficult for homeowners to make their mortgage payments, which is actually some spot-on honesty for once, okay? The reason why we're seeing the delinquencies, oh, maybe it's because unemployment's going up. Oh, maybe because too many people borrowed more than they could handle and bought too much of an expensive house, and expenses have rose substantially. And of course, natural disasters is always a factor as well, but that's not a huge part of it because these delinquencies have been going up over the past 4 months, guys. The 2 major hurricanes that just hit Florida just happened over the last month. So the delinquencies have already been on the rise well before that. Interestingly enough, the amount of loans that are in foreclosure is actually down 12.5% from this time last year. And it's also still 34% below pre-pandemic levels. Well, why do you think that is? If delinquencies are going up and foreclosures are lower than they were a year ago, how come? 2 reasons. The first one is a lot of these folks luckily still have enough equity where they can sell the house and avoid foreclosure. That's part of the reason you're seeing this big uptick in inventory. These are people that can't afford the houses anymore and make the smart decision to sell that house instead of ruin their life in foreclosure. Smart. The other reason is because the people who are not that smart and choose to take it to foreclosure and decide to have that awful foreclosure on their permanent record, they're continuing to get bailed out by the mortgage servicer and the federal government. I mean, look, guys, I just talked about this a week ago, where if you live in one of these disaster affected areas, you can get your mortgage on hold for up to a year now. If you have a Fannie Mae, Freddie Mac, or FHA or VA backed loan, you can get that mortgage on hold once again. Even if you're already late, even if you're already facing financial difficulties, you can get it postponed once again. But to give you the idea of scale right now of how many borrowers are hurting, like it doesn't sound like a lot that, you know, we have 3.5% of people that are delinquent right now, until you look at how many people that actually is. That's 2.07 million properties either late on their payments or in foreclosure at this very moment right now at the end of October in 2024. So we barely have 1 million homes for sale on the US housing market. It's, you know, around 1 million, give or take which data source you look at right now. But imagine if even half of those properties made it to foreclosure, the amount of inventory on the US housing market would double, okay? Double. What do you think that would do to home prices? Now, that's not going to happen because of the 2 reasons I just mentioned before. The smart ones will sell, the dumb ones will take it all the way to foreclosure and ruin their credit and ruin their financial life. But the smart ones, of course, are selling right now and cashing out while they can. But the other ones who are kind of delaying the inevitable are either going to end up in foreclosure and those properties will eventually hit the market, or at some point during that process, they'll kind of wisen up and realize that, hey, this is probably a bad idea. Let me just sell this place now, even if I have to take a loss, because it's better than ruining my financial life. But either way, these properties that are in distress are going to come to market. Very few of them are going to do some sort of loan modification because that requires taking on a lot more debt. And even if they do, the expenses to keep the home continue to rise, inflation continues to go up, squeezing these people's wallets. So anybody that's having a hard time affording their house right now, towards the end of 2024, no matter what they do, besides making a lot of extra money, they're not going to be able to really hang on for much longer. This is why you're going to see the inventory on the US housing market continue to rise, more distress continue to build in this market as more people can't pay, all at a time when interest rates are going up because the bond buyers don't believe that inflation has been tamed. This is like literally the perfect recipe for home prices coming down, guys. No buyers, worst home sales since 1995, interest rates going up, and inventory going up. So anybody that's been patient waiting to buy a house, your day is coming, and it could already be here if you find the house of your dreams right now. So keep all this in mind. Make sure, remember, I can set you up with a real estate agent if you need that. The link to that's always down in the description below at your convenience. So if you enjoyed this video, please make sure you are subscribed to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.